Okay, g'day, Rudy here. So this video is off the back of a question from a subscriber. Rudy, I've never owned an ETF and frankly have never had much interest in them until I stumbled across your channel, even though I've owned and traded ASX shares for over 25 years. Could I do a vid on, and he's got a number of questions here, which I'll get into. So a very good question. It's sort of a reason I started the channel, because I've been through the shares thing and seen the light with boring ETFs. Alright, now I'm only really good at charts. I can't do graphics because graphics is probably make things a bit easier, but anyway, I'll give it my best. So what are ETFs? So they're like buying a share, except the underlying investment is not directly an investment in a company. It's an investment in a particular index, in which the ETF holds the physical shares to match that underlying index. Okay, hopefully that makes sense. So it's important to note they are not active managers of the shares. They're not like, let's sell that one today, let's buy that one. All they're doing is just replicating a particular index which has its own rules created. Okay, so they're not punting. Now most of the ETFs are market cap weighted, which so the heavier weighting is to the larger companies and vice versa. So as an example, there's this VAS, so Vanguard Australian Share ETF. So its job is to track the ASX 300 index, and so that ETF actually holds the 300 companies in the index according to that index weighting. So they actually hold the shares like in trust type thing. So it's the same as if you went and bought all those 300 shares in the weighting of the index. And so all the dividends that the company's paid gets paid to the ETF, and then every quarter or half or annually, they, depending on what type of ETF, they pay out a distribution from the collection of those ETF dividends. Okay, so that's the VAS. Then there's the one I've been talking about this weekend, the new king, MVR. So it tracks an index called the MVIS Australian Resource Index and has 31 companies in it. So this ETF hasn't decided I'm going to pick these 31. This ETF has decided to track this particular index. So all these ETFs, they track an index. None of them are making a punt on something as like an active. So hopefully that makes sense. Okay, fees. So they charge an annual fee ranging from 0.1 or 0.07, I think. Well, let's just say so 0.1 to 0.5, depending on the complexity, like the rules they have to adhere to, and the FUM, like how much money's in the ETF, because obviously if it's big, then they can offer a cheaper fee. So you get something like VAS, which is probably the most popular ETF in Australia. This tracks the share market index. I think it's actually 0.07 before someone pulls me up, but so that's pretty cheap, really. MVR, they're charging 0.35%. And one of my favourites, the GDXJ, which is a US-based ETF, they charge 0.5, but I don't care. Because I get some people who say, oh, what do you want to pay so much for an ETF? Yeah, I'm not. If you're investing in an ETF hoping you're going to make 5%, 8%, then this stuff matters. but I'm investing in ETFs to make a lot more than 10%. And so this is like, I'll go through, but this has got 91 global gold mining companies in it. So I don't mind paying 0.5% because I know it's going to make more than 10. So now the fees are deducted from the unit price of the ETF. So it's not deducted from your bank account. So it's, you don't see. So they take their clip from the, from the unit price of the ETF. Okay. So liquidity / pricing. So ETF providers provide a unit price each day, and with the big ones sometimes, like quite often during the day, of the market value of the ETF. Because the ETF will have some arbitrary number, like the value is 90 or 54, or like absolutely no relevance to what, like the ASX 300, might be at 7,000 points, but the ETF's at $46. So they provide price guidance, but obviously during trading hours, the ETF will go up and down according to the underlying shares. Or if in, say, VAS, you can just use the ASX 100 index as a guide. So if the index is going up, then the VAS is going to go up. So they trade all day like a share. So there's buyers and sellers. By buying shares, you're not really pushing up the ETF price. Like if you're on a specky, trying to buy a specky stock, you can buy up, and push the price or whatever. So you're not really doing that to the ETF price. Unless you've got like $1 trillion and you put it in the ETF, and the ETF had to go and buy all those $1 trillion worth of shares. But I don't think we're in that league here. So pushing, and vice versa. If you go and sell, you're not going to push the price down. So the ETF providers act as a market maker by buying or selling actual shares in the open market to keep the ETF in line with the index. Okay. Hopefully that's making sense. Alright, this is what I always do. So you've got to do your own research, because the ETF can fluff about and talk about and make it look really special. So what you've got to do is Google the ETF and read about it and see what fluff they've got to say. But what I do is you've got to go and look at the actual companies in it. So you scroll down to the very bottom and have a look at what's under the hood, I like to say, because if I want to go and try and look at which way an ETF's going, it's a lot easier when you go and look at like the top 5 to 10 holdings, because they generally take up the majority of the weighting of the ETF. And if all those top 5, 10 stocks are all trending up, well, the ETF's going to be trending up. If half are up and half are down, well, the ETF's probably going to go sideways. Hopefully you get the gist. So look at the companies and their weightings to get a true picture. And the same as dividends, like they might have a declared dividend that they say they pay, it'll be passed. But you go and have a look, like at MVR, you got BHP, Rio, Fortescue, you sort of know what dividends they're paying, so it'll give you a feel for what the ETF's going to pay. And then they spend there's like a whole ream about past returns. I just skip right past it because I don't care. Check their charts. I don't care about past performance. It's about future. Okay, so what do I like them? Okay, so you get access to an instant portfolio of shares, and this is a big one, including international shares in one purchase. Just bang, there you go. Aussie, American, Italian, German, English, Chinese, or depending on what ETF you're doing. I like to invest in themes, that have long-term trends beginning. There are all different types of thematic ETFs to choose from. So I'm going to go into a bit of, I don't know what it is. Okay. Technology, this is like why I don't like the VADS VGS combo. That's the outcome of what I'm about to say. I hate investing in an index which is mixed up with all different sectors. I'd rather pick the sector within the index that's going. Because, okay, so here's my rant. So VGS, which is it tracks the MSCI World Index, so 70% American, and then off it goes to the rest of the world. And Australia's like 2% of it. So VAS outperformed the Australian share market significantly for the last 10 years. So you shouldn't have been in VAS. Now IVV, which is S&P 500, outperformed VGS significantly for the last 10 years. So you shouldn't have been in VGS. NDQ, so the Nasdaq outperformed IVV significantly for the last 10 years. So you shouldn't have been in IVV. And then you can keep going down. Semiconductors outperformed the Nasdaq significantly for the last 10 years. So you should have just been invested in semiconductors. Now that's, you can say, oh yeah, it's hindsight. Yeah, but there's, you could have just started with this one here, VAS. Like, we're 2% of the market, the world market. Why would you overweight us? And I know super funds, and it gets me going. A growth super fund option is like 40% Australian. Anyway, I'm getting off track, but I just wanted to say that. Now, I understand too, if you're just investing in Australia because you're comfortable with that, then that's fine, or especially when it comes to shares. Because I'm saying like VAS as an index, because I'm sure you can build a share portfolio that could beat semiconductors. Okay, let me clarify. So this is all about if you're investing in like an index, because I'm sure you could have built an Australian share portfolio that outperformed semiconductors. You could have had a good crack, I reckon. But I understand, because you know Australian companies. But in saying that, banks and resources roughly go in cycles. So in Australia, you should be overweight banks and underweight resources, and vice versa. So right now, you should be switching out of banks and into resources, because it's just how it works. Where you should be starting to go now. So where should we? So resources. Why? Because it's showing a bullish basing pattern over tech. That was that video I did the other day with them, just comparing MVR to the Nasdaq. You can see that basing pattern. So it's a signal. The gold price has been outperforming the Nasdaq since the beginning of the year. So if you just bought gold, like nothing fancy, just gold, you're outperforming the Nasdaq, the hottest sector. Now you're lucky if you're Australian-only investor, because we've got lots of companies blessed with it. I mean, imagine if living in Singapore, you've got no mining companies that to buy. You get the gist. Just another little rant. The stupid government wants to shut it down and not use it. Like all that uranium we've got, we could be a powerhouse for AI. Coal, we could have cheap electricity. None of this windmills, in 15 years they're going to fall over and rot the earth anyway. Get back on track. Now, there are many resource sector focused ETFs. Okay, so MVR, the one is a diversified Australian only minor ETF. But in reality, it is overweight iron ore, because that's what we are. We're just we're full of other resources. Like, we've got a lot of gold. We're known for our gold. Anyway, but that's the point. Is it's only Australian focused miners, but it's still good because resources are all going up. Iron ore. That's why iron ore's now started to become bullish. There's like a GDX ETF, which purely focuses on the largest global gold miners, and it tracks this NYSE Arca Gold Miners Index. So you've got some of our gold miners in there. There's a GDXJ, which focuses on smaller global gold miners. It tracks this global junior gold miners index. So again, the ETF's not picking it. They're not making calls. Okay, core and satellite. So if you're an Australian only focused investor, what I'd be doing is using MVR as a call, as in like a major holding, and then go and add individual shares around it to overweight it to what you want. So like if you want more growth, then add some things like Linus, Playdon, Pilbara Minerals, like some or some specky smaller names. But at least you got MVR there as your rock. Or if you want more dividends in your portfolio, then load it up with, some other miners or ANZ or Millen Shakespeare or whatever takes your fancy. But for me, I'm global, not really satellite, more equal weighted, and I go for US based ETFs, i.e. you can't get them on the ASX, unfortunately. So things like this LitP ETF, which is full of global lithium miners, which include like Pilbara Minerals and IGO. So some of our miners are in there, but you're in there with the world's best lithium miners. Same as this rare earth ETF. You've got liners in there and a bunch of whole other rare earth miners from around the world. SilJ, global silver miners, GDXJ, global gold miners, URNJ, global uranium miners. So these you can't get exposure on the ASX to. So that's, but I know, well, I want to say I know, that's why, that's where I want to be exposed in this resource space. Now there are Australian, like in other words, ASX-based ETFs that do, when you buy them, you're buying global, like this food ETF, which is based on agricultural stocks. I don't think there's any ASX-listed stocks in this one. They're all global companies involved in agriculture. There's this wire ETF, which is copper producers. So I think that's got one of our copper miners in there. So MVR now, exclamation mark, because I haven't really talked about MVR apart from this weekend, because I've been waiting for it to turn. There's a GDX ETF, or MNRS, which is a hedged version. So they're global gold large companies, gold mining companies. So again, they've got some of ours in there, but from around the world. URNM, large uranium companies. So this up in the US has got the same, except they're at the junior level. When I say junior, they're not like specs. They're big companies like this. GDXJ has got Evolution in it, which is one of our biggest. So, because the big boys have already run, so I'm backing that the little boys are going to start following. Got a fuel ETF, which is all your Chevrons of the world. Actually, it's so Woodside doesn't even get a gig in this ETF. That's how big they are. And then things like PM Gold ETF, which just gives you exposure to physical gold. So the ETF holds physical gold, or ETP Mag ETF, which just holds physical silver. So, any questions? So hopefully that answers the question, and other people if around ETFs and how you can use them. I like them for the reasons I've just said, and they help you reduce risk. Like the Boss, that Boss Energy, how it fell out of bed. If you invested in the uranium ETF, which Boss is part of, that uranium ETF didn't fall out of bed like the Boss price. So even and Boss Energy is a better miner than Paladin, cost of production wise. So there's a legitimate reason for buying Boss. That things happen with mining companies. All right. Thanks for listening. Geez, that's a long one. All right. See ya.